morning, everybody who will be zooming into this eventually. I'm Tony Mounce from Tony Mounce Mortgages. Catherine CQ from the Property Otago Investors Association has kindly invited me on this morning, and I'm just going to go through a small presentation for probably, I don't know, about 25 minutes, talking about the things that most people talk about in our sort of world, interest rates and COVID, LVRs and such like, and just the general environment of lending and banks and second tiers, etc. So it's just going to be a general overview. Anybody's always most welcome to email me at any time after, and that's just tony@tonymounce.co.nz. So thanks, Catherine. We'll get into the first slide, which is the next slide. Okay, so after a career at the Bank of New Zealand, I set up Tony Mounce Mortgages in 2009. We've now got a team of about 30. The business has gone well and grown well, and we have won quite a few awards in the New Zealand mortgage market or advisor market, including the last year I was the Mortgage Advisor of the Year. We are the principal sponsor of the Canterbury Property Investors Association and the Otago Property Investors Association. Very proud to be associated with the two associations, and I suppose a big part of my job, of course, is the investor market, whereas other people, perhaps new first home buyers, etc. Right, thanks, Catherine. The next slide. Okay, so I'm just going to very quickly, because a lot of the people on the call will be experienced, but I always focus on a very simple application first, because it all starts with the application, and the banks are very exact nowadays, going through your budgets line by line. I'm sure you've heard of this. They actually do sit there and look at your bank statements, so you need to get your application correctly. Whether you're a first home buyer, a second home buyer, or a 100th home buyer, they will go through it, and they will go through it very carefully. So as I say, we can flick through these quite quickly, Catherine, because everybody on the call will have probably done a home loan application. I just really want to get to the bones of it. So if you carry on through there. So this example, and you can have a look at it when you're doing your next application and use it as a bit of a roadmap. But page one's obviously just page one with the name and address of people, etc. And then we just have a very standard funnel, what it is, whether it's a first home buyer, a second home buyer, or investor. It's always the same. You buy something, you're either putting cash in or you're leveraging, obviously. And then you've got typical sort of people, you know, joint income 112,000. They'll obviously have rental income if they're buying a rental property. Typical mortgage, what the payments are at the interest rate based on 30 years. As I'll explain later, while we do this on the application form, the banks obviously use a very high test rate, which I'll explain shortly. Most people have a few what I call rats and mice, car finance perhaps, a couple of credit cards, etc. Some people might have a student loan and might have several HPs. Often I will do a consolidation if the application looks a little bit messy for a start. Sort of 2 or 3 things is fine. 8 things is probably not fine. Anyway, then they do go through this. So they are going to compare this to your bank statements, etc. And fair enough too. They've got to get it right to see what the expenses are. So you do actually have to spend a bit of time and concentration on your budget. And of course, it never hurts to have a budget anyway. People should know what they're spending. But apart from that, I'm just basically saying that the banks will look at it. They will look at your budget. They will look at your bank statements. So just some duty of care with the form is required. Close enough is not quite good enough. And the bank, of course, is looking for a healthy surplus of, say, $1,000 a month might be a nice surplus to have. This particular couple had 2,000. But the bank is looking for a nice buffer because, as I say, they do use a higher test rate. Again, fairly typical people. These ones were first home buyers. They've got their $120,000 deposit. They've got some life insurance. They've obviously got some KiwiSaver, a car. And on the next page, they've got their liabilities. As I say, this is absolutely fine. These people are fine. They've got a couple of, as I call them, rats and mice. It's not terrible. Probably wouldn't look at consolidating them into one, although I suppose we could look at giving them a personal loan of 31,000 so that they only had one debt to make their life a little bit easier. Or we could use some of that deposit, of course, to pay off the debts and then have a slightly low LVR under 20%, but they would then, of course, pay a premium on the loan of between 0.35 and 0.75, depending on the LVR, the loan to value ratio. Just to give you a quick idea on the service calculator, these people had a surplus of basically 1,000, like I said in the earlier piece. We just punch it in. The biggest thing to notice here on the service calculator is the test rate of 7.2. The banks, and probably due to COVID, are playing very conservatively. With the crash of the OCR and the crash of the interest rates, the banks have not lowered their test rate, and they still test on about 7. And I think that is obviously to do with COVID and being careful. I think it will come down to 6, which is probably a more relevant test rate to use in today's sub 3 interest rates. But at the moment, they are still using 7.2. Obviously, if you pass at 7.2, that's wonderful news because the interest rates have a long way to go up. So just to make sure that the audience understand what I mean, that's not the interest rate. The interest rate is as low as 2.65 at the moment. That's the test rate. So in other words, the bank is pretending that the interest rate is 7.2. And on this page is the credit cards, etc. Thank you, Catherine. And then it has the expenses as per the previous one. And that's where they get to the surplus of 992. The difference on the actual application form was that, of course, we were using 3.55, not 7.25. Speed limits, well, they've gone. So the Reserve Bank wiped LVRs on the 1st of May, which was absolute music to my ears. It was just, I'd been calling for it and it happened. And now I've been calling for the test rates to drop, and hopefully that'll happen as well. The problem is that the banks haven't adopted them. Well, one has, that's Kiwi Bank, and BNZ will on a case-by-case basis, but the main thrust of the banks, the other 8 or so, are still using an 80-70 mix. So I think, again, it's just a time thing. We've had the COVID crisis, and I think the banks are just feeling their way to see how the economy goes. The Reserve Bank getting rid of the LVR allows the bank to make their own decision on what their LVR is, in other words, what their risk profile that they're happy to take. And over time, assuming that this success that we've had with COVID permutates into a solid housing market going forward, which either will or will not happen, which is probably too early to tell yet, but the LVRs should come into line with the old 80-80-80, hopefully. Construction, most banks still allow construction to be over the 80% and the first home buyers to be over the 80%. So obviously a new build is a construction loan, but also a investment property is also considered exempt. That's under the old rules, but as I said, most of the banks are still playing by the old rules, so it's still relevant. Construction loans either by a progressive drawdown loan or a turnkey. I'm sure you know what that means. The turnkey is more convenient because you only pay a 10% deposit and then you pay the rest on settlement, finished, code of compliance and insurance, whereas a progress payment is that you buy the section and then make staged payments on the building contract. The turnkey is more convenient because it's easier, 10% down and the rest at completion, but probably is slightly dearer overall with these low interest rates, because there's often a finance charge from the building company in there. But interest rates are so low that a progress payment loan is probably cheaper at the moment, but turnkey is more convenient. Difference between owner-occupier and investor is pretty obvious, really, but the owner-occupied can actually have as many as 3 properties can be classed as owner-occupied, and in general terms, that's the actual owner-occupied where you live. Then there's the holiday home, and some people are fortunate enough to also have a city apartment that can also be a second owner-occupied if you live out in the country and then travel to the town. A lot of people use that third owner-occupied actually for their children at the university, for example. So technically, it's actually possible to have 3 owner-occupied properties. Sorry, I've already really covered that. We'll move straight on to the next slide. Non-bank lenders, they're becoming more and more prevalent in this country. They have a perhaps slightly less test regime and are already at 6%, most of them. And the likes of the Resimax, Bluestone, Pepper, Liberty, the usual non-bank providers, their interest rates are pretty respectable now, as low as 3.39 at Resimac, so not massively higher than the banks. And because they are more likely to do your 80-80-80 scenarios at the moment, pending the other banks getting more comfortable, we're still seeing a lot of business in that second tier market. Right, let's just race through COVID-19. I'm sure you know what's available out there if you are affected, but we'll just go through it very quickly. So the mortgage options were pretty easy. Obviously, the first one was do nothing. The second one is if you were fast tracking, for example, you had a 15-year loan on a 25-year term, you just lower your payments back to the 25-year term. Interest only, that's a lot of people have done interest only loans. And that's just what it is, converting your loan from principal and interest to interest only. But the biggie is the mortgage holiday, which isn't a mortgage holiday, it's a mortgage deferral for 6 months. What happens? There's no payments. But there is, of course, at the end, you've capitalised or compounded the interest for that 6-month period. So therefore, at the end of the period, of course, you've got a bigger loan. For example, $500,000, your loan has gone to about 508 in the 6-month period. So it's not really a mortgage holiday, is it? It's a mortgage deferral. But look, if you have to do that, you have to do that. You have to do what you have to do to get through. And even though our response to COVID has gone very well, obviously we're not out of the woods yet with tourism, hospitality, things are still difficult. And I think at date, there's been about 150,000 New Zealanders do either the interest only or the mortgage deferral. So it's quite significant numbers, but you probably may have thought it would be more than that. The wage subsidy, just race through this. I'm sure you know what this is all about. I'll race straight down to the bottom. The wage subsidy finishes on the 12th of June, I think it is. If your actual business is down by 50%, you can then apply for a 12-week extension. The minimum figure for the full-time people was 585 and part-time it was 350. A lot of business, of course, have paid the wage subsidy and then topped up to approximately 80% of the salary if the people have still been working. If they haven't been actually able to work, a lot of them have just got the 585 because they haven't been able to work. And of course, that company therefore has lost all that revenue. But it's been the real saviour of just so many businesses in New Zealand. It's just been a wonderful thing. And as I say, it's been extended for 8 weeks if your income is down by 50%. I suppose the worrying piece is at the end of the wage subsidy, are there going to be a lot more redundancies? Time will tell. The small business cash flow loan. through the IRD. That's been very good. A lot of New Zealanders have taken that up, because if you do repay it in 12 months, it's totally free. You can see that it's $10,000 and then $1,800 per full-time equivalent. The interest rate, if you don't pay it off in the 12 months, is 3% over the 5 years. This is a very simple loan to apply through the IRD, and really does only take 5 or 10 minutes. It's very quick and paid out almost immediately, 2 or 3 working days, and it's for businesses with fewer than 50 people. But that's been a terrific tool that businesses have been able to use. And then there's the business guarantee scheme, which has probably been a little bit disappointing. There's only 60 million lent of the 6 billion out there. It's been quite, I suppose, stringent regulations might be the way to put it, to get the loan approved with a fairly full business plan requirement, and also paying the loan back in 3 years makes your cash flow have to be very robust. So it's proven to be a difficult loan for my clients to get approved. If you have had a look at the bank documentation, you'll probably agree it's quite full, that'll do. So therefore, the take-up of this loan has been minute as a percentage of what's available, i.e. 1% of the allowed has been lent. But just briefly, the government guarantees 80% of the loan, the bank takes the risk for 20% of the loan, and it's for businesses up to 80 million who can apply for, up to 80 million turnover who can apply for 500,000, but it does have to be paid off over 3 years. So you have to demonstrate that when your cash flow returns to normal, you can pay it off in that period of time. Insurance, we have had an influx of insurance requests. I think this is just really, the situation has made people realise just how important insurance is. Nobody wants insurance. It's seen as a waste of money until you need it. Unfortunately, sometimes you need it. So it's just one of those annoying expenses, but it's perhaps the single most important expense you can have in your life. So obviously always think about insurance, because we don't know what bad stuff is just around the corner. Yes, it's almost like a wasted expense, but it is sometimes necessary to have. Okay, the good stuff. Let's flick over there, thanks Catherine, to the interest rates. Obviously the stock swaps have just plummeted in the whole world over the last 12 months. This graph is over about 16 months, and you can see that it's gone from 2% down to 0.25. So, nearly negative, isn't it? It's just been incredible. We thought we had low interest rates a year ago. Well, we've got even lower interest rates now. So home loans, it was 2 weeks ago, and it was just fascinating for somebody in my role. It was almost every day. We had 299, and we had 289, and 269, and then 265, and this was all happening in a period of just 2 or 3 days. We now have 5-year rates under 3%. It's just so difficult to comprehend just how low they've got, and of course we all know that they can go even lower. So it's amazing. Unlikely in the world at the moment that they're going to go up in the foreseeable future, obviously, while the uncertainty and the difficulties in the world persist. So the interest rates will be low for at least a period of time. For that reason, I personally prefer your annual rollovers. Gives you a strategy of keeping your eye on the ball, means you review it every year, can make a lump sum payment, put your payments up, and it's almost like floating. It's not really, but a year is so quick that it's very, very fluid, because the year goes so quickly. Most banks allow 5% freebies anyway, so you can still make a bit of a lump sum during the year with a lot of banks. And then if you review it at the end of year, as I say, you can make a lump sum then, or you can put your payments up. Review the interest rate, just keep the eye on the ball. If they're starting to go up again, of course, you can then lock in longer. Now, when rates start to go up again, even if it's halfway through, it's free to get out because the bank only charges a penalty when the interest rate falls, of course. When it's going up, it doesn't, and you should only probably miss 1.25 OCR increase. So the 1 year has a very low risk factor. Oh, this is just a bit of a graph between Aussie and us. They're at 0.25 on OCR, and so are we, and their interest rates are quite a lot lower than ours. And the reason for that is very simple. Their deposit rates are a lot lower than ours. We have to have the money in the bank to fund our mortgages. Probably say 75%, 80% comes from internal deposits, and therefore the people who have term deposits need to get a return, and that's why we probably might not get into negative in New Zealand, but you never say never. Park your money in the bank, well, that's that negative thing. It's hard to comprehend having 100,000 at the start of the year and only having 99 at the end of the year. A very difficult concept to get your head around. And because our term deposit rates are required to pay our savers and we need to fund our mortgages internally, not externally, I don't think we're going to get into negative, but I don't know that. And it's interesting times. We'll just have to see what comes out. You know, I've got a bit of a feeling we're near the bottom of the cycle, but you know, we don't know that. So it's not to say that in New Zealand we won't have a 1.5% interest rate, because of course we didn't think we'd have a 2.5% interest rate when we had a 3.5% interest rate. So nobody knows the bottom, etc. But I don't think we'll get to negative, but we could be, you know. But people, because they're getting very low return in the bank, are still looking at investment properties. Obviously, residential investments are at least slightly recession proof, because a human being always has to have a home, and with job losses, etc., the welfare state obviously does pay the rents directly to the landlords, etc. So there's a little bit of a cushion there, which is why people remain interested in investing in residential investment properties when the returns on the term deposits are so low. In Christchurch, we're quite fortunate to have high yields, you know, the 5 to 6%, not uncommon, whereas Auckland, of course, lower yields of 3 to 4%, etc. So we remain busy, we remain people interested in investing in property. That is good. Landlords are important. People have to have houses to live in, and not everybody can own a house, obviously. The funding, the banks are still tight out there. In the commercial field, it's particularly tight for developers. All that type of business is very difficult to achieve through banks, because they are conservative at the moment, keeping a good eye on their liquidity. The liquidity is actually probably better now, and so far the Reserve Bank has all the banks back, as I say, and have been very proactive in making sure the liquidity remains sound in New Zealand. So that's good news. The Reserve Bank have been excellent in their tools that they've used during COVID, etc. So the money is okay for liquidity for banks, but they're just taking a very conservative approach. So commercial/development funding is a difficult place to be in, and second tier financing is very much in vogue at the moment in New Zealand. So a lot of just finishing on there, a lot of the second tier that we talk about are firms like the FMTs, Southern Crosses, etc., who do fund the short-term commercial/development type loans, etc. So the money is still available, but it's not perhaps readily available through the banking system as it was once. Business funding, same thing. It is quite difficult As I say, the bank's looking very closely at affordability, but they always come back to the three pillars: the personal factor, cash flow, profitability, and security. So we always focus on the three pillars to make sure that they are strong, then everything else dovetails back into it: the balance sheets, the profit and loss, the cash flows, etc., payment history. But they always fall back on the three pillars. It's not brain surgery, it's not rocket science. Your credit rating is very important. Keep your credit rating clean. Remember, the banks now can see if you paid your power bill on time, etc., through Centric. So just be clean and tidy, pay your bills on time, and you'll have a good credit rating. Don't default on anything. Pretty obvious stuff. Cash flow and profitability, but that's what pays the loan at the end of the day. And security is the ambulance at the bottom of the cliff. In business, the security can be a bit weaker sometimes because there are cash flow lenders out there. So number 1 and 2 must be strong always. Number 3 can be a little bit weaker, but obviously it's best if all 3 are very strong. Obviously today is not the same as the previous time I did this, so there aren't any questions, but you are all most welcome to email me, tony@tonymounce.co.nz, if you do have any questions. But my last pitch is not a pitch at all, it's just we have seemed to have done so well in the last 8 weeks or so, and the market for investors and everybody looking at mortgages with these rates so low seems positive. As I say, I do put a little bit of a caveat on that with the wage subsidy, but we are busy here at Tony Mounce Mortgages. People are buying property. I had a lady pull out of one yesterday because there were 5 offers already. So that's quite incredible, really. In these times, you'd think that it would have slowed down, and it probably has a wee bit, but I am quietly optimistic that we have come through this well, and the interest rates is obviously a good benefit of what's happening in the world, even though it's a bad thing that has been happening in the world. So as I say, 2.65 is the low. Is it at the bottom? Don't know, but it could be, etc. So thank you, Catherine. Thank you for the opportunity. Hopefully there's something in there for everybody. And as I say, the audience are most welcome to email me if they do have any questions.